Rajat, morning and good to have you back on ET. Now, Rajat, the world is looking like a broken down place once again. Global volatility has shot up. The Fed has admitted the obvious problems and there is no recovery in sight for, at least for European economies. Rajat is...
Well, yes.
So how would you characterize the market environment? A bit dicey, a bit scary, or this is a great time for long-term investors to buy stocks?
Well, I think throughout this 2011, we have been living in a period of uncertainty. And over the last 3 months, the global uncertainty has overtaken the domestic headwinds that we have seen in the first 6 months. We are now almost getting used to this 2 to 3% daily movements in the US markets or the global markets. Almost on a weekly basis, you are seeing either a set of positive news or a set of negative news. I think you can start sensing out that there is some element of frustration which is building up now, just because even if the markets are in a range, ever since this range of Nifty shifted down to 4800 to 5100, a 2% volatility almost looks like happening every alternate day. So right now, no strong views, and we just hope that this range prevails right now. I think this current 2 to 3 week period is going to be quite critical for the markets to decide whether they break down further from here or not, because you can just start sensing out that the US government, the US Fed, the European governments are basically doling out some of their measures, and how does market react to that is going to be very critical to decide whether the fall that we saw in this year stabilizes here or we see these markets cracking down further.
So Rajat, would you wait for the dust to settle down in terms of how the global markets actually absorb what the FOMC minutes had to say, or would you start nibbling in, considering these are attractive levels, to start doing that?
Well, if you divide the market in two parts, one is when markets start factoring in some slowdown and some concerns about growth getting impacted. I think the markets are almost there. From here on, the drive down in the markets will largely be event related. If you recall 2008, between Jan and September, the markets drifted down significantly and the valuations almost bottomed out at around 12 times. The next 15-20% fall was driven by events which were difficult to forecast. I think we are right now at the end of that first leg, where markets today index trades at closer to 12 times FY13, and in another quarter FY13 will start becoming relevant. We are trading at between 12 and a half times FY13. Okay, only if you want to wait for an event risk, you can see these markets drifting down, and that's what I mentioned. These next 2-3 week period, next 1 month period is going to be quite critical. I would sense that we can start focusing on individual stocks, where despite the index falling by 17-18%, you have individual stocks which have fallen significantly more. So these are times for investors to start readjusting their portfolios.
Rajat, you've been a contra buyer into the cement pack. Much before the market also spotted, you identified this space. These stocks have rallied a fair bit. Does it seem like the fizz is going to last, or is it time to book out now?
Well, I think generally cement is a space which is difficult to trade, because first, it's not a large allocation, and second, they are not so liquid. So we have been advising investors that this is a time for one to start building up cement. There are two theories which support this. First, we think that at some point of time, either December onwards or first quarter of next calendar year, we will start seeing the shift happening from global growth to domestic growth for investors. We have started seeing pricing holding out quite firm for the cement companies, which will help them to drive their profitability. Second, which is a more important point, I think we have entered a period where setting up new capacities in India is just going to be far more difficult and far more longer. This in itself will raise the premium for many existing capacities. Cement is something where you just can't set up capacity in 12-month period. Companies take almost 2.5 to 3 years. Then you have problems of land, limestone, water, several other issues, which basically mean that in the next upcycle, the existing cement capacities will get far more premium. And you have almost all the companies in the sector where the balance sheets are clean, your profitability in the worst time still remains intact. Companies on an average make 700, 800 rupees EBITDA per ton, and I think valuations are at replacement cost. So if you have been in the sector, just stay invested. Don't hurry out just because the sector has outperformed.
State Bank of India, 1971 rupees for State Bank of India. Rajat, do you think the pain for State Bank of India in the near term is far from over? Yes, the stock is looking attractive based on price to book, but the challenge is margins could come under pressure and NPAs could move up.
From the operating dynamics point of view, I think margins should more or less remain stable between 340, 350 basis points for SBI. As far as the credit cost is concerned, I think markets typically get more worried in advance about what the numbers could look like. This has particularly been true for SBI, at least for the last 2 to 3 quarters, where you saw big dent in profitability coming because of the provisioning. But a lot of that were adjustments which they had to do to comply with the new provisioning norms. I think if you look at the provisioning numbers that they are going to provide from here over the next 2 to 3 quarters, that will still help them to report a profit of almost 2,500 crores in the coming quarter and closer to 3,000 crores in the subsequent quarter. From a number point of view, now you are getting this stock like almost closer to 1.1 time book. Okay, we really are not forecasting any big spike in the credit cost because it didn't happen even in FY09. Okay, when things were far more terrible than what they look like right now. I think they would be, right now they are earning very well on their top line. Until the time these banks earn 340, 350 basis points of margin, they can definitely take care of higher credit cost for them. So the stock has now almost halved from the high it made a year back. Okay, generally these are stocks where book values keeps on compounding. Okay, in 2 years time the book value for SBI will be almost 40% higher. Okay, which basically mean that even if the stock remains at the same multiple, you should get a return of 40%. If you see some valuation upscale of 15-20%, then we are talking about a compounded return of 25% in the stock.
Rajat, your house came out with a report on road infrastructure yesterday saying that, project awarding momentum will only pick up pace from here onwards. What are your best buys in that space?
This was a report which came out of the takeaways from a recent conference that we attended in Delhi, and the key conclusions that we learned from all the participants there is that last few quarters have been a very slow period as far as order intake is concerned. In fact, this quarter when companies will be reporting, at least on the road construction side, I think we expect a significant slowdown, not just on their P&L account, but also on the order momentum that they have been seeing. Okay, from a buying point of view, I think right now stocks are dictated less by the order intake and more by how much damage is happening in their P&L account balance sheet. Some of the companies can report loss also in this coming quarter because of the interest cost. As of now, these stocks look very cheap, almost all the stocks in the construction pack, but I think the risk element has just shot up significantly. Plus, you have media reports of some event related, some inquiry related stuff which keeps on going on. At best right now, let the dust settles in. I think we will get the winners only once we get clarity who comes out cleaner out of this entire mess that we are seeing as a result of the slowdown.